It's often said that many markets go up the stairs but down the elevator. In other words, short trading can move much more quickly than long trading. So in this edition of our Strategy Blueprint series, we're looking at how short-term traders can use one of the most powerful tools inside Seasonax for shorting markets. And that is event seasonality. For short traders, the market often moves the most when expectations suddenly change. A major economic release can be an inflation report, central bank decision. These can all trigger very sharp price movements within just a few minutes. So the challenge isn't finding volatility, it's knowing which events have historically produced meaningful moves, how large those moves have typically been, and how much risk you should expect. And that's exactly where Seasonax can help. So let's start by defining the trader type. A short trader will typically hold positions for minutes or hours, particularly if they're trading an economic event. They're focusing on fast momentum and expanding volatility, and they tend to trade around scheduled economic events. They're looking for quick, high probability opportunities. And unlike swing traders who want trends lasting days or weeks, short-term traders on the short side are primarily interested in the initial market reaction. And the challenge, of course, is separating genuine opportunity from random volatility. So how do you find the best economic events to trade? Well, this is where Seasonax can help. Not every economic release will move the market equally. Some announcements consistently generate significant price movements. Others can barely move the market at all. And using Seasonax's event feature, you can analyze recurring events such as Federal Reserve meetings, Bank of England decisions, ECB meetings, CPI releases. And you can see all those meetings here. These are the different central bank meetings. You can look at these GDP, UK, Germany, CPI prints for the Eurozone. You've also got the major US releases, NFP, ISM services and manufacturing. You've got CPI prints. You've got US GDP. So instead of relying on instinct, you can see which events have historically created the biggest opportunities. So let's look at the US non-farm payroll. And straight away you can see here, on the day of the US non-farm payroll, you can see all the moves in the euro dollar over the last 10 years in every single non-farm payroll print. You can see the maximum gains, losses, and the overall result. Now, one of the biggest mistakes short traders make is having unrealistic expectations. Sometimes the market's already priced in the news. Sometimes a large move can be statistically unlikely, and Seasonax allows you to analyze, average post-event moves, the maximum historical advances, maximum historical declines, typical trading ranges. So let's take a look here now at the pound, for instance. We'll look at the pound dollar pair. And let's say we want to have a look at the pound dollar pair over a central bank meeting. We're going to look at the Bank of England interest rate meeting when the Bank of England has a rate change. And what you can see is when the Bank of England has an interest rate decision, on the day of the decision, you get to see the average post-event move. So on the actual day, the average return is 0.49% negative. You can also see the maximum moves. So you can see the maximum fall on a Bank of England interest rate decision day was 2.04%, and the maximum gain was 1.42%. So this gives traders just straight away a much better understanding of what can constitute a normal move, right? And what could be considered exceptional. You can just see at a glance what the maximum gains and falls are. Now, once you understand the historical reaction, you can begin to set more realistic profit targets. Rather than selecting markets arbitrarily, you can compare today's market with previous reactions. Questions become much easier to answer. Has the market already traveled its typical range? Is there still historical room for continuation? Or has price already exceeded what usually happens? So let's stay with the Bank of England interest rate decision, and let's now look at the euro pound, right? And give ourselves a worked example. So here you can see on the actual day of the release, we've got a average return positive of the euro pound to the upside, and straight away you can see, right, what the maximum gain and the maximum fall is. So for short trade, we're looking at the maximum fall is 0.97%. And actually, if we look at the maximum drop here on the right hand side, you can see that actually the euro pound, the maximum it's ever fallen on the Bank of England interest rate decision is 0.97%. So that means if you are expecting or wanting to short the euro pound, the interest rate decision is in line with your expectations. If you were sort of seeing the euro pound move -0.75%, you're quite close to the maximum move. And there's only been one occasion in the last 10 years where the euro pound has moved more and to the downside, and that was here on the 18th of March 2020. So this means traders can take profits based on historical evidence rather than the emotion of looking at the chart thinking, oh, I feel there may be more to go, I feel there's less to go. No, you don't want to go on your emotions. Look at the historical data, and you can see the moment you're getting anywhere near -0.97%, you're approaching the maximum drop there's ever been in that instrument. Now, how do you use this for stop loss calibration around economic events? Now, economic releases naturally generate volatility, but how much is normal? And Seasonax helps answer that question by showing the historical post-event behavior. And this is very helpful. Say we want to go back to the pound again on Bank of England interest rate decision. And you can see here that when you get a negative fall, look, there hasn't been any positive rise there. So when the pound dollar has fallen, there hasn't been any maximum gains. Here, fallen, no maximum gains. Fallen, no maximum gains. Fallen. Look, no maximum move. It's 0%. Here, 0%. So when the pound dollar falls on a Bank of England interest rate decision, you can quite quickly see that the move is really quite one directional. It's not like the volatility is chopping. Oh, there was a maximum gain of 0.5%, then a fall of -1%. No, it tends to be quite unidirectional. So that can be very helpful to say, okay, well, that could mean on a Bank of England interest rate decision, when I'm expecting the pound dollar to fall, I could have my stop at the 0.00% gain point on the chart. Again, extremely helpful for stop placement. And this allows short traders to place stops outside of normal event-driven noise while still allowing them to manage risk appropriately. Another advantage of event seasonality is understanding which markets tend to respond most strongly. Different events affect different asset classes. For example, central bank decisions may create the largest moves in currencies. Inflation data may have a bigger impact on interest rate sensitive assets like the Nasdaq, for instance. Employment reports may produce stronger reaction in equity indices. And so you can use the event feature to compare the different markets. So let's say we want to look at the Fed rate change. So here's let's just look at a Fed meeting. So here's the Fed meeting. And we want to see, okay, pound dollar, you can see the maximum gains, maximum fall over a Fed interest rate decision. Well, let's compare that to the euro dollar. Oh, okay, euro dollar maximum gains 1.24, maximum falls 1.25%. And let's compare that to the S&P 500, right? And we'll just have a look here. S&P 500. And there you can see on the interest rate decision. Okay, look, maximum profit. Wow, 2.99%, 11.98%. So again, really quite different. Let's look at the Nasdaq. Let's just look at the NDX. It's going to be easier. There we go. And there you can see, look, maximum profit 4.26%, max loss 12.19% on a Fed meeting. So straight away you can start to compare different asset classes over different events. The highest quality opportunities will often occur when historical event behavior aligns with technical structure. For example, if a market is approaching a major support level, a key resistance zone, a breakout pattern, or an important moving average. Now, if that technical setup coincides with an economic release that has historically generated strong directional moves, great, because the probability of a meaningful opportunity may improve. So seasonality doesn't necessarily replace technical analysis. It provides valuable historical context before the event unfolds. So the key takeaway for short traders is simple. Economic releases create opportunity, but understanding how markets have historically reacted to those releases can help you trade those opportunities with greater structure and discipline. And using Seasonax's event feature, you can identify the most significant economic events, understand typical market reactions, set realistic targets, and calibrate stop losses, and focus on the markets most likely to move. Because successful short-term trading isn't simply about reacting quickly, it's about reacting with the benefit of historical perspective, and that's where Seasonax's event feature proves invaluable.